responsibility for taking care of the retirement needs for over 1 million civil servants, as well as an excellent track record of delivering inflation-beating returns. John Oliphant and his investment team are members of a select group of investment managers we refer to as masters of the markets. Well, that is quite some terminology, masters of the markets. And you've got it here in your financial highlights, John. Your investment portfolio grew by 13.7%. That's from some 911 billion rand in 2011 to more than 1 trillion rand in assets in 2012. So everyone wants to know, how have you done it?
Yeah. No, thank you again for inviting us. I mean, I must say that we truly enjoy being on the show, sharing our views and also getting feedback from our stakeholders around what we can do better. But I must say that despite the economic environment, the portfolio of the GPF is continuing to do extremely well. And that's mainly that we keep into the basics, of investing. As I've said before on this show, that we really prefer to buying real assets, and that's what we've been doing. And then also we've been busy transitioning the portfolio towards our new strategy. And I think from that perspective, I think we will be gearing the portfolio also for further growth going forward, notwithstanding the fact that there are challenges.
John, I think just in terms of the fund, it's obviously fantastic to see that the government's fund is growing at far in excess of inflation. Considering all the problems that we see in the world today, and obviously bearing in mind that the fund is very focused on investing in South Africa, what's your sort of expectation for inflation and the ability of the fund to deliver inflation returns over the next decade? I mean, we have over 1 million civil servants you need to take care of. Mm-hmm. When you do your planning and you think around these issues, what's the sort of internal target you guys set yourselves in relation to inflation?
Yeah, the liabilities of the GPF is our benchmark. And you know that the liabilities grow, in line with inflation, because we are a defined benefit fund. Salary increases in line with inflation. You've got pension increases also in line with inflation, and then you've got other areas that contribute to the growth of the liabilities. But what we do is that we follow what we call an ALM exercise. We do an asset liability modeling, and through that we establish portfolios that increases the probability of the GPF in terms of making sure we are able to meet those liabilities in the long term. So we use a liability-driven approach, and also I think what has contributed significantly to the GPF's portfolio has been the type of assets that have been identified through our LDI approach, and which mainly it's property, and we know that property has done extremely well, and the GPF it's got a good exposure there, and then also inflation-linked bonds. I mean, they've done extremely well in the current environment. So there's quite good asset classes that gives you an inflation hedge, but also they've been able to provide nice capital growth in terms of the overall portfolio of the GPF.
Do you remain a big fan of inflation-linked bonds going forward?
If inflation is going to surprise on the upside, yes, because there's a nice inflation hedge in terms of the income that you'll be getting out of that asset.
So you're saying that inflation is, in your opinion, going to surprise on the upside, John?
We have long-term investment views, and I think if you look at quantitative easing, you look at low interest rates in the context of the South African economy, we think in the long term, in all likelihood, inflation might surprise on the upside, and also having a good exposure to inflation-linked bonds, we think to some extent will hedge us against that. But also, earlier on to your earlier question around where are we only domestically focused, we have reviewed our investment strategy, and now we have a 5% allocation to the continent, excluding South Africa, and then we also have an exposure to offshore markets. So to some extent, we have some exposure, and we've been transitioning the portfolio to take advantage of those opportunities. And then in the domestic economy, we've been trying to say, look, let's look for opportunities outside the listed sector, because invariably opportunities in the listed sector limit you in terms of what are the real opportunities in the economy. And invariably our stakeholder engagement today was mainly centered around what the GPF will be doing going forward, especially when it comes to unlisted investment in the context of South Africa, as well as the overall continent, going forward.
John, and just in terms of that, this is quite a different skill set. Buying a listed company, it has certain governance standards, which may not be at the same level in the private sector. So let's just talk about some of the skills that you think that you need to have in order to do that successfully, and how you plan on changing the way your investment team can handle some of these investments, and also evaluating, I'm sure, a large amount that's going to be coming through your door asking for capital.
Yeah, no, thank you, because that's an excellent question. I mean, I agree with you that the risks in the unlisted space are far higher than what you'll get in the listed space, and you probably need a different skill set. And the GPF, working together with the Public Investment Corporation, which is our key partner in investing, we have been looking at the governance structures, and that's why we haven't made any significant investment in the past financial year. If you look at our annual report, we'll see that we have a minimal exposure to unlisted investments, and that's mainly because we have been working very hard in reviewing the overall governance structures around unlisted investments, and we believe what we have put in place, will lay a very good foundation. We don't think, we're the custodians of governance. We believe that we have learned from our past experiences. We've also interrogated best practices globally, and then we try to work on what is best for the GPF going forward. And we've put governance proposals, which we announced today to stakeholders, and that would be on our website very soon, so that people will understand how the model has changed. But I agree with you that all the changes were geared around making sure that the governance structure is solid and can respond adequately to opportunities that emerge in the markets. And then one of the greatest challenges that we had in the past was our ability to respond to opportunities quicker. And we have said, look, let's see how we can amend our structure such that we are able to assess opportunities and be able to respond adequately.
Where are those opportunities in the unlisted environment in terms of what you're seeing right now and your ability to respond quickly?
Yeah, look, we as you know, I mean, through our previous engagement, we've got what we call a developmental investment framework, which has 4 pillars: investments in economic infrastructure, investment in social infrastructure, investment in sustainability projects, and then obviously investments in enterprise development. So that philosophy still stays with us. We believe that there are significant opportunities in those 4 pillars. So that will be one area in which we will play a meaningful role. And then also the overall private equity space. I mean, we are mindful of the fact that the private equity environment in South Africa, it's been opened up, especially with the amendments to Regulation 28, and I think many pension funds, not only the GPF, will start looking into that asset class. So we need to manage the transition very carefully in a way that we're not going to put too much money and chasing few opportunities. So we need to get that balance right. And then on the continent, I think our 4-pillar strategy will still hold water, because I mean, everyone can talk about the consumer story and so forth. At the end of the day, when you have emerged as a middle class, you want to have access to cell phone, you want to have access to good infrastructure, you need all those things. And we believe that at the back of the successes of the African story will be a possible investment in infrastructure opportunities to unlock Africa's potential going forward. And then at the back of that, you can look at real estate, you can look at the consumer story going forward. And that's the type of things that we'll be playing around. And
so
we have
many opportunities, Warren.
Yeah, I think just to touch on some of the social, you've identified a couple of things that you want to do, and you've actually mentioned in the press release an example of how you want to put some of this to work in terms of social transformation. You recently bought or made an investment in the Kiat Private Hospital in Nelspruit. So just to take us through that and how the mandate, it's almost a mixed mandate in terms of having a financial return attached to an investment, as well as helping the country develop its social and economic infrastructure. So perhaps you can tell us how you did this investment with the Kiat Hospital.
Yeah. No, let's not focus on a narrow project. Let's look at the philosophy and the overall approach of the GPF. In 2007, 2008, I mean, that's the time when South Africa was experiencing power crisis. That's the time when Eskom communicated that it would no longer be able to guarantee the supply of energy to the South African economy. At the same time,
it could be on the cards again.
Yes, and then at the same time, you had the economic crisis out of the US. And when we did a careful analysis, we realized that some of these investments where you're thinking that it maybe is a state utility that need to look at, they have material impact on the equity portfolio. If you look at the mining sector, for example, there were requests that they need to shut down the aluminium smelters. That had an impact on the profitability of mining companies, had impact on earnings, and in return had an impact on the equity portfolio. So we need to get the balance right, where we're saying we need to invest in economic infrastructure and to generate good returns, but at the same time, we're also minimizing the possibility of downside risk by ensuring that the economy has adequate infrastructure to support the growth. And then coming to the social infrastructure, we did our research and we found that, let's take for example an example of housing. We found that the the GPF, and in particular the members with police people, teachers, nurses, we found that they were too rich to qualify for what in South Africa we call an RDP house, which is a house from government. But yet they were too poor to qualify for a bond. And when you look at it,
a very
it wasn't
tough position,
to be
between
in.
a rock and a hard place there.
Yes, and also when you look at it, it's not necessarily that they are not qualifying for a bond, but it's because the housing market is not supplying the type of houses that they will necessarily be able to afford. So we looked at it and we said these are massive investment opportunities, and there are certain projects that we have backed, developing houses in Soweto. One is developing houses between Kempton Park and Midrand, and all those projects we see that they are generating excellent investment returns, but have a real impact on the social outcomes. So we, from the GPF perspective, we worked out a framework that allowed the GPF board to still exercise its fiduciary responsibility of maximizing returns, because we still have to pay pensions, we still have to give our pensioners good increases, we still have to give government, the main sponsor, the assurance that we're doing things responsibly, so that in future they don't have to contribute higher contribution rates into the fund. So looking at all those different stakeholder interests, we found a model that allowed us to be able to maximize returns while having these wonderful social outcomes.
John, I just have to come in here and really press you on it, because if it generates such great investment returns, my counter argument is surely the market should take care of that. So if you're having to step in and you're seeing these opportunities and you can seize on them, where you're fulfilling both your fiduciary responsibility to obtain returns from your investments and a social function, I have to ask, why is there this market inefficiency, and why isn't the private sector taking this up? The private property developers, as well as the banks, funding some of these projects. Yeah. Why has this been this opportunity for you guys to make this investment?
Yeah, no, that's an excellent question. And the reason I say that is
they're the masters of the markets.
Yeah. There's never free lunch in economics, and when I say these are excellent opportunities and we have identified them, it's logical to ask, why hasn't other people been doing it? And I agree with you. But now, to answer it directly, I think it has always been a function of regulatory constraints. Let's leave out the bank out of the equation. Let's talk about pension funds. The Regulation 28, which governs private sector pension fund, to some extent had serious limitations around to what extent can pension funds invest in unlisted investments. That has subsequently been amended, and we've got a new Regulation 28 that allows pension fund to have a significant exposure to unlisted investments. But obviously, it's a new area for most pension funds. This is a recent amendment to Regulation 28. Yes, I would expect many pension funds to look at these investment opportunities more seriously going forward into the future, but I think in the past they were unable to look at them because of regulatory constraints. From whether the private industry is doing it, yes, they are doing it. I mean, I'm not here wanting to promote other service providers, but I think there are brilliant, good products out there that invest in these assets. And I think, just to mention a few, Future Growth, for example, has been running this asset a portfolio of this nature for a long time. And it has, if you look at the risk return characteristics of it, it further confirms our view. The PIC on our behalf have done some of these projects, and many other institutions within the South African economy has done so, but investment capital has not really been supporting them to some extent, and that's mainly as a result of regulatory constraints. So I think the opportunity to some extent is there for pension funds to look at, but I also think pension fund trustees would like to have some time to further understand the asset class better. So I think from that perspective, the GPF is slightly ahead of the race.